Welcome to the Thematic Edge podcast. I'm Marvin Barth of Thematic Markets. This week, Mark Farrington of the Global Watchtower and I are joined by Danny Dayan of Macro Musings by Danny D. Danny is a former global macro fund manager with a background as an options market maker. He writes Macro Musings by Danny D on Substack, where he does deep dives into the nitty-gritty of macro markets in search of mispricings that offer opportunities. This discussion came at the behest of ex-readers who wanted to compare and contrast my views with Danny's. So Mark took the reins as MC in this episode, quizzing Danny and I. We started with our current views on the U.S. economy. Danny and I share a view that the Fed has committed a sequence of policy errors that imply not only strong underlying momentum that will support above-trend U.S. growth, but that inflation, which is already running at nearly double the Fed's target, is likely to accelerate sharply without rate hikes. Both of us see inflation expectations as the key driver. The Fed lost control of them going into COVID and never fully contained them with its 2022 to 2023 rate hikes. And then it committed a major policy error by easing rates significantly below neutral in 2024 and 2025. As we explain in our discussion, that removes the Fed's ability to, quote, look through the current oil price shock and requires them to hike, regardless of the potential effect on output and employment. But this is where Danny and I diverge. As I've written since early last year, when I forecast his nomination, I think Kevin Warsh was chosen to reform the Fed, to downsize its balance sheet, and to pursue prudent monetary policy. Hence, I expect him to be a hawk, and the only questions are whether he pushes balance sheet downsizing or rate hikes first. Danny disagrees, as he believes that Mr. Warsh wants to cut rates to placate President Trump, but that he's going to be blocked by the rest of the committee, which has shifted to what he calls a do-nothing mode. We also briefly discuss our differences on the effects of Fed downsizing, and Mark closes with his big picture assessment of our views and the macro outlook. Before we dig into this fascinating discussion, let me just remind you that nothing we say on the Thematic Edge should be considered as investment advice. Our discussion is for informational purposes only, and that you need to do your own research before making any investment decision. With that, let's jump in. Welcome to the Thematic Edge. I'm Marvin Barth, and we have my usual co-pilot, Mark Farrington of the Global Watchtower here. But today we're joined by our special guest, Danny Dayan. Danny, welcome to the podcast.
Thank you guys for having me. My only regret is I don't have fancy art behind me. Well, you guys do, but thank you guys. I'm really excited for this conversation. It's going to be really interesting.
Well, you know, my mother. So Danny, this conversation came about because you and I had been just sort of trading sort of direct messages on X about some of our similar views, and then we had a couple conversations on the phone where we have a lot of alignment of views, particularly around mistakes the Fed is making and a positive outlook on the U.S. economy, concerns about inflation. We also have some differences in terms of where we think the Fed is going to go, and in terms of how that the balance sheet is going to adjust and affect. And you had tweeted about that, and all sorts of people had kept coming back saying, well, I want to be part of that conversation, or I want to hear that conversation. So we thought that this would be a good opportunity to go ahead and have you on here. But before we get into conversation about those specific issues that everyone was so excited about. For the people who are not familiar with you, can you tell us a bit about who you are, what your background is, and what is your sort of method or shtick, so to speak, in terms of global macro?
Thank you for that. Thank you for the introduction. And I'm glad we were able to turn this around, quickly. Very, very opportune time to talk macro. Yeah, my background, I've been in the industry for 20 years. I've had a variety of different roles. I would say, at a high level, we're talking about the intersection between global macro and derivatives. I've worked with derivatives, my entire career, from a risk management capacity to sales trader to then eventually buy side, opportunities, launching my own hedge fund. And now I run a macro newsletter, Macro Musings by Danny D, where I really focus on that intersection, at a high level, digging into the global macro environment. I'm very quantitative with my framework. I try to model everything. Obviously, there's limits to what you can do on that, but I try my best. And then, where are the thematic opportunities in markets? Looking at where is there an edge to express trades, in the option markets in particular, where I can construct asymmetric profiles. I look at I look at the global economy, not just the US, although the US is obviously a huge focus, as well as, all macro markets, from equities, rates, FX, commodities, etc.
Fantastic. Now, given that I think a lot of the sort of questions between us are more between yourself and I, and we have more background, I thought it would be a good opportunity to turn to have Mark sort of interview the two of us. So if you don't mind, I'm going to turn over the reins to Mark and suggest that he presses us both to our limits in terms of what our views are.
Yeah. Okay, thanks, Marvin. That's excellent. I can rely on you to do the research for me, so I can make some important non-investment decisions in the come in the coming months. But yeah, let's kick it off by getting both of you to give us your take on where you see the U.S. growth story traveling. It looked like it, started 2026 very strongly, and then, we've had the energy shock in March. And now in mid-April, with the big relief rally in the equity market, it looks like the left tail has been partially cut off. What's your outlook for, the U.S. growth for the rest of the year now, on the back of the worst part of the shock, and also the global relative view, if you like. So let's kick it off with you, Danny. You're the guest. What's your outlook?
Sure. Coming into this year, my view was cyclical upside in that the Fed had cut below neutral rates in my estimate of neutral rates last year. And in line with that, I viewed the rate cuts as a policy mistake. Now we can get into the Fed later. I know we will, but that this would lead to the cyclical aspects of the economy reaccelerating. Certain parts of the economy that had been stagnant for the last few years, while the core story of AI and fiscal spending and services spending would remain strong. And so I viewed this as a cyclical upside story. Obviously, the war, was a major event that could put a wrinkle in that. So far, the way it's playing out is a more moderate outcome. It could get bad again. We'll have to see. But from the standpoint of, oil's in the 90s, that is basically a source of inflation. It's more of a nuisance to the consumer than anything that is catastrophic in terms of growth.
Mhm.
It could certainly go bad, and a lot of oil experts are saying it will go bad. But as it stands now, I don't think that derails, anything. And I actually see conditions more conducive with us heading to an overheat situation than any sort of downturn. I think the labor market is significantly more tight than the Fed has given credit for. And a big reason is the demographic shifts that we've had
Mhm.
throughout this cycle, but also now since Trump came into office. The labor supply story is the big story that I've been talking about since, the fall of last year. The Fed kind of got a little bit worried about the labor market, and I was basically saying they shouldn't no longer worry about the labor market because in a country of 350 million people, when you have a break even of 0 to 30K per month, it doesn't take much to generate that in terms of job growth. And so I see the labor market tightening and I see inflation accelerating. And I think that growth is going to be quite robust, possibly overheat. That's the key risk I'm looking at.
Fantastic, fantastic. Marvin, how have you adjusted your outlook for the year?
Well, so in many ways, it's very similar to Danny there. I mean, this is one of the areas where we both agree that the Fed is tremendously underestimating where neutral policy rates are, and that is the federal funds rate that keeps the economy at its sort of neutral normal temperature. And that they did commit a policy error over the end of 2024 and through 2025, cutting rates as much as they did. That was providing a significant amount of stimulus. One area where I'm not sure it's a difference, but I would add to Danny's view is, one of the key themes that I've seen is driving this cycle going all the way back to the early part of the last decade that was only really interrupted by COVID is this localization phenomenon that has been driving CapEx. So well before the AI CapEx boom, if you look, CapEx as a share of GDP has been rising continuously this entire time.
Yep.
And CapEx has been the main driver of this. And that is shifting production back to the US. And what happened is, of course, you had Trump shock 1, then you had COVID shock, then you had Trump shock 2, Liberation Day, all of which said to any firm out there that was sitting on the fence about using the increasing amounts of technology that allow you to reshore through automation, to go ahead and do that. And if you look at the announced investment, and it wasn't just AI. In fact, if you look, only about 45% of the total announced investment last year after Liberation Day was AI. A big chunk of it was manufacturing. And it was 75% of the total announced investment in the global economy from publicly announced companies was coming to the US because why not? You have higher levels of productivity, you have a supportive environment, all of these things. And then on top of that, you have interest rates that are too low, set by the central bank. And
Mhm.
so, for all the reasons that Danny suggested, plus I think more, you were going into a massive acceleration in the US economy that was already apparent by the fourth quarter. To Danny's point, the economy was operating at full employment. My math is a little bit different, but we basically get to the same point that the
Mhm.
Fed was massively underestimating that the break even is a lot lower in non-farm payrolls than they thought.
Mhm.
Um, and most importantly, that they had never fully contained inflation expectations, which they allowed to get out of control in 2020. They accelerated rapidly from there. They caused the massive inflation. That was a absolute policy error on their part. They fortunately did try and start correcting that through 2022, but they didn't finish the job. And then they started cutting. So what we can see now is not only can you see it in very clearly in the inflation expectations numbers, and I'm not talking about break evens. Break evens are not inflation expectations. Break evens are markets forecasts of it, and the
Yeah.
markets have been totally wrong. Um,
Mhm.
Consumers set prices, consumers and producers, not bond traders. And those guys are telling you that inflation's going up and that they're willing to accept higher prices because they believe the Fed is behind the curve.
Mhm.
And you can see that showing up. I mean, the acceleration in the last couple of months you look at 3-month annualized inflation is off the chart. We're over 4% in PCE core. Like the Fed has completely blown it again. And that's the problem that they're going to face. So I think that's the real challenge combined with, as Danny says, there's a big oil shock. That oil shock, as noted, we don't know what the size of it. As you and I discussed in our last episode, Mark, I still see a significant chance that this could go very badly.
Mhm.
How big a negative impact that's going to be on the US is not clear. What I can say is the US is clearly going to do a lot better than the rest of the world, and that to Danny's point, in either case, this is going to be an inflation shock that the Fed is going to have to deal with.
Okay, fantastic. Well, you've both highlighted that the Fed had made errors going into 2026, and probably what they were least hoping for was yet another supply shock to test their reaction function. But yet, this is what we've had, and so I think maybe we start with the analysis of these supply shocks as a segue into Fed policy and whether a new chairman will approach the monetary cycle differently. So on the supply shocks, the COVID was widely viewed as this asymmetric shock where, half of the economy was shut down and there were still a few sectors that were growing. And so there was an attempt to look through that as a supply shock and focus it on a policy responsive demand creation. The last two or three, I should say, Russia, Ukraine 2022, China critical minerals in October, and then now energy again in March 2026. They're kind of classic supply shocks. So how do you think the Fed should react? And is it different this time? Is the fact that the starting point is so poor, as you've both articulated well, is that going to be the deciding factor? Or is the Fed just going to get better at managing these external shocks and all the other central banks as well? Danny, why don't you kick it off?
Yeah, I think you highlighted this very well. The starting point matters. And so I'm going to kind of jump into neutral rates and things of that nature. Marvin defined them very well. The Fed's errors this cycle, in my opinion, all go back to their estimate of neutral rates. And so if you actually go back, their estimate in Bernanke's world in 2007, he had 4.5% kind of nominal neutral rate. And then the GFC was a deflationary, sort of bad demographic cycle. All these balance sheet recession cycle took it down to 2.5% by their estimate. And they've really stuck around there. They're at 3% due to the Williams model, which frankly, this model broke in 2010, and yet they continue to look at it. You can go on their website, it looks broken. And the problem with this neutral rate is that as the Federal Reserve thinks that neutral rate is 3% in that range, it leads to a bias. And the bias is that growth as long as we're above this, growth will weaken, unemployment will rise, and inflation will fall. And they have constantly thought this since 2023. And the real aspect, when I look at the neutral rate, I come to a far different number. And I know Marvin has a little bit different number than me, although we're in the same ballpark. I come to it from a number of different areas. One is you can look at other models that the Fed has. The Lubick-Mathis model is around 4.25. You look at the market-based estimate, 10-year, 1-year OIS rates, which is well beyond any cycle, 4.3%. And then you look at evidence from the economy, right? And if you look at evidence from the economy, at 5.5, maybe they were mildly restrictive, and at 3.5, they're loose relative to a sort of neutral, if that range that I'm giving you is accurate. The economy is telling you that home sales, new home sales, durable goods, industrial production, ISM manufacturing, none of these contracted at 5.5%. If they were deeply restrictive at 5.5%, you would have seen a contraction in these interest rate sensitive sectors. Instead, you saw stagnation. You saw stagnation. And as soon as they cut last year, you've seen these all accelerate. This is in line with my cyclical, sort of upside view. And so, Marvin pointed out, actually, core PCE on a 3-month annualized basis, 4.4%. We've had 3 straight 0.4 month over months. Very hot. And that has nothing to do with the war. This is pre the war impact. So now come to the war and supply shocks in general as a conversation. I think the issue is, if you go back to last year, oil went up in June for 2 weeks and came back down. That is as transitory as you get with this. Everybody in the oil industry is telling you this is not transitory, that this is going to have lasting effects on oil supply, dramatic lasting effects on oil supply. And we're starting to see supply chain issues all across the economy in other areas, food and helium and things that affect semiconductors and autos and all these areas. I think it's going to start cascading. And I think the issue is that makes it not transitory. I'll give a great anecdote. Airlines said, we're raising prices because jet fuel has gone up. However, if jet fuel goes down, we won't lower our prices. Where's the transitory? It's not transitory if that's the behavior. That's a behavior change. And we have multiple supply shocks at once. We have the labor supply shock from cutting the immigration. We have tariffs, which is another supply shock. And now we have a broad supply chain issues that I think will be on par with 2022, just from a supply chain standpoint, happening. These are more supply shocks in just a few years than we had in 40 years. So the Fed, I think, needs to recognize that this is a new normal, that this is the world we live in, and responding to one transitory supply shock, ignore it. Look through it, fine. But when you have a series of supply shocks, what I've seen in academic and research is it shifts inflation up. Like, sure, it won't stay at the highest level that it gets to, but it will shift it up to a higher floor. And obviously, when we've had 5 years of above target inflation and inflation was accelerating before this, I think this is where the Fed is in major, major trouble and too loose. And when you have reduced supply in the economy, the commodity traders know this. When you have reduced supply, you need a demand response to then balance, right? And instead, we have financial conditions running around like it's 2021 all over again, meaning we're stimulating demand in response to contracting supply. So I think the Fed is in very far behind the curve on this, and they need to tighten. They may not need to tighten as much as if this was like a demand shock, right? But they need to tighten for all the reasons that we talked about, including, in particular, inflation expectations, which are completely unanchored from consumers and businesses alike. So that's where I stand on it is it's a different prescription than it would have been last year when oil just went up and down, over the course of a month.
Fantastic. Marvin?
Yeah, so for me, the expectations play a really critical role because if you think about how producers respond based on where expectations are, it's very different if expectations are stable versus if expectations are higher or rising, right? So if you have low or stable inflation expectations, then in any market where producers have a margin, and thus the discounted future value of that margin means something, they absorb the shock. And you can see this over and over. So when we did have stable inflation expectations, we had plenty of supply shocks throughout the previous 20 years before COVID. Mm-hmm. And, suppliers, time and time again, there might be a short-term 1 month or 2 month blip in inflation while you're adjusting to cost shocks for things that don't have margins or things like that. But in general, if you're Coke, you don't pass on the price shock to your customers because you lose that margin to Pepsi for the next 10 years, and that's too much of a loss. You just absorb it. You say, okay, we've got a supply shock, we'll make it up later. That all changes once you create expectations of inflation. Then all of a sudden, the producer has an incentive to say, I'm going to try and sneak one by because maybe the customer is going to think this is just that inflation they were expecting and not me gouging them, and they don't switch over to Pepsi, right? Exactly. And that's what happened during COVID. The Fed made it very clear, we're going to create inflation. Get ready for it. It's coming. We're going to do it this time. Make no doubt about it. And you can see it in the inflation expectations numbers. They jumped, right? Yeah. And then lo and behold, you get a cost shock on that. Of course, all the firms decided, hey, let's take advantage of this. Yeah. And so that's the mechanism by which cost shocks do become persistent, is because you allowed inflation expectations to become embedded. And once that happens, then yes, you as a central bank have to react to them. So unfortunately, because the Fed screwed up so badly, they
Yeah.
now actually have to react to these things. They could have viewed them as transitory shocks if they hadn't allowed inflation expectations to get out of control, but they did. And again,
Mm.
this comes back to the mistake they made in the last year and a half, is
Mhm.
that they were starting to get them under control. And you could see that in the sense that
Yeah.
if you look at inflation dynamics with consumption dynamics, so real personal consumption expenditures, how much people are really spending in the economy, the volume of goods they're buying, it varied inversely over the last 2 years with price inflation because producers were trying to again sneak these ones by, but the consumers were like, I don't know, maybe the Fed is taking care of this. And so they pull back on consumption. And that would have normally done it. But as soon as producers leveled off and we get a slight dip in the inflation rate, boom, inflation consumption would accelerate again. What's been really scary is in the last 6 months, we're getting the exact same pattern that we got during COVID. Real expenditures and inflation are going up together. That is, again, gosh, those guys at the Fed completely screwed up. They are not concerned about inflation. So I'm not worried about my real income because this is all nominal prices. I'm going to keep spending. And so that's why they're going to face a real problem here. And I think this is going to be one they're going to pay for.
Mark,
Okay, fantastic.
I'd love to jump in with some
Yeah,
additional
sure. Follow up,
points
Danny. Go ahead.
to what Marvin said, because he's spot on with everything he just said there. The inflation expectations and the household savings rates are really the channel that we're going to be watching for all of this. And so I'll chime in with that. He's right. The tips market is a bunch of traders sitting on trading floors trying to make money in forecasting, and they've been off by like something like 1,600% over the course of the cycle in projecting inflation. On top of it, and my own nitpick is the Fed bought a ton of tips and that manipulated that market to a degree where the message is not as kosher as everyone thinks it is. But when you look at the University of Michigan series, I look at the headline one that everyone looks at is the median, which tells you half the numbers are above here, half the numbers are below here, or half the respondents, I should say. I look at the mean because the mean tells you the tails, right? I want to know if consumers think inflation is 10%, and I want to know if on the other hand, they think it's zero. You want to see those tails to understand that. It's 7.7% on a 1 year basis. The 5 to 10 year is 6.9%. I mean, if you look at a chart of these going back, we have lots of history of this to the 70s and 80s. This is the most terrifying chart I've ever seen in my life. And the Fed just ignores it and tries to come up with these other, surveys that they think will give them the answer they want. And they are ignoring what consumers are saying. And when did this start responding? Under the first rate cuts under Biden, in 2024, it shot up as soon as they started cutting rates, and it has stayed elevated and picked up a notch under Trump. So, it's not a political thing. It is strictly a monetary policy thing that they've allowed this to get there. And the Boston Fed has a model that I have incorporated. I'm not the genius that they are. I just borrowed their model and recreated it where you can decompose the inflation expectations to oil, food, and core, and then unexplained. The unexplained is completely 1980s territory. It's very scary. The other thing I'll point out to is their use of forward guidance. I'm going to rewind to Q3 2023. We had 8% nominal GDP quarter. The economy reaccelerated after Silicon Valley Bank. And what did they do? Waller comes out and Powell comes out and they start talking about we're going to cut rates. And from then on, every single speech is when are we cutting rates? How much are we cutting rates? What are we going to do about rates? Everyone hears this and everyone's behavior responds to this. So when I think of the transmission of monetary policy through the economy, it's through the household savings rate. When you hike rates, There's a lag of usually about 12 months. Consumers get cautious. Their savings rate goes up. Also, interest rates are higher. It's better, economically to save. And there's a lag there where they become a little bit more cautious with their consumption behavior. Typically, it's about 6 months after rate cuts where the savings rate starts to come down. They get more confident that the economy will grow, job prospects will improve, so on and so forth. And they respond by being a little bit more aggressive with their personal budget. In this cycle, the savings rate declined 6 months before their rate cuts even began. So a full 12-month differential of what it should have been. And it's clearly because every single speech was, when are we going to cut rates? How much are we going to cut rates? We need to cut rates 5 times a week. This is all we heard from the Fed for the last 3 years. And so this is where I really come to the root of their errors is if you look at these dynamics, inflation expectations and the savings rate, you know that we're in trouble. And I think we're in trouble.
Okay, well, let's use this as a segue into the Fed now. And, of course, it looks likely that Kevin Warsh will be nominated and in place. So I think we can start this topic by the two of you, framing your outlook for him and this supposed regime change we're going to have. But I think it would be also helpful if you linked it to some of these failures that you've mentioned, because Warsh has already made clear in testimony, his writings, that he wants to do away with this forward guidance as much as possible. He wants to reduce the amount of public speeches and commentary that the president and the board members make. And he's talked also about changing CPI measurements and things like this. So he's already telecast a few of his plans, which are clearly based on addressing part of these failures that you both have mentioned. And then I would also think it's useful if you can to still relate it to the business of managing supply shocks, because the school of thought on how monetary policy should respond to supply shocks is not being driven only by the US and the Fed discourse. I mean, globally, there's literally a consensus amongst the G7 central banks that a classic supply shock like this should be addressed by fiscal and industrial policy, not monetary policy. And yet both of you are arguing that it needs a monetary policy response, I guess primarily because of the starting point. But let's tease that out as well, because we're talking about Warsh not only changing the consensus and regime within the US, but more than likely challenging the regime more globally amongst the seven central banks. So, Marvin, do you mind kicking this one off for us?
Well, you addressed a lot there, Mark.
Sorry?
You addressed a lot there. There's a laundry list that I could attack. Do you want to start? I mean, that is a very good list, and we need to go through the whole thing. But where would you like me to start?
Well, I guess let's move the argument on to the Warsh Fed.
Yeah.
And as he comes in, first two meetings and attempts to facilitate this regime change, is it going to be done philosophically, or is he going to come in and try to address some of these outstanding issues? Because honestly, the way you've both presented the argument, the Fed's behind the curve, and there's no time to waste. So I guess I'm asking, how does Warsh address that time pressure versus the long-term goal of regime change?
Look, I think there's definitely a long-term plan here in my view, and it's one of the reasons why I was early on saying one that Trump would be appointing a hawk, not a dove, that it was either going to be Besant or Warsh, despite his rhetoric. I was saying that early last year, and that this was about absolute root to branch reform of the Federal Reserve. That and the underlying source of that is a long-standing populism in America that has been very anti-centralized finance, has been against money center banks. This goes, you can take this back to Jackson, you can take this back to the Granger movement, you can take this in some sense actually back to FDR, even though FDR gave us the current. It's also why, this um, uh, um, American Bankers Association, which is mostly small banks, has always been such a powerful lobby in America. But this was a very big movement against this centralization of power within the Fed, its big imprint on the economy. And that's why they're always talking about the balance sheet. That's why they always are talking about downsizing. And remember, Kevin Warsh resigned from the Fed in 2011 in protest of the large balance sheet. Like nobody has a more credible voice on this than him. He has been very consistent on this, that he thinks this was a mistake and that the Fed needs to reduce this. The flip side of that is that one of the key reasons why the Fed has to maintain a large balance sheet now is the Basel III capital accords that came in after the 2008 crisis. And you have the other whole side of the Republican ledger that wants lots of deregulation and growth and let's finance everything. And of course, they want all that deregulation. Well, those are two sides of the same coin. You can't downgrade the balance sheet unless you get rid of all that regulation that requires the Fed to be that heavily intervened in treasury markets. So sorry for the preamble on that, but
No,
I
that's
think that is ultimately where he wants to go. The fact is he's one person on there, and maybe you have one or two others on there who are going to agree with him on that. So the first couple of meetings, they ain't going to get that done, and they ain't going to move in that direction. Okay.
Mhm.
To the point of what Danny and I were talking about before, this inflation problem is going to be front and center.
Okay.
And I definitely do believe that Kevin Warsh is a hawk at his heart. I also think he's definitely not a sock puppet of uh, Donald Trump. This is a rich, good-looking guy who has plenty of respect across the street. He's not going to throw it away for Donald Trump. I'm sorry, that's just not going to happen. And he's going to do what he thinks is going to make his career and his name in history, which is to do the right thing on inflation. And so I do think that regardless of what he's been saying in terms of, we're getting a positive productivity shock. And by the way, he's got that backward. That usually means that you have the disinflation in several years, not on the front end. You've actually raised R star, the
Yeah.
rate on this one. Whether he was saying that to just get across the finish line or what he needed to do, he also, one of his key core tenets he's been saying all along, which is one of the things I find very admirable about him, is this advocacy of what he calls epistemic humility, that they have to stop thinking that models are the way to run things and
Yeah.
that they actually have to look at the economy around them. Well, if he means that, and I think he does, then he's going to look at the inflation numbers and say, guys, we got to hike rates. And if you
Mhm.
look at what the rest of the committee has been recently saying, while they will
Mhm.
never admit that they screwed up,
Yeah.
sadly, I think, if there were justice in the world, they would be forced to. But it does look like he will be able to corral a majority to do that. But the big picture reform, balance sheet downsizing, I think that's going to take some more appointments and changes in the presidents.
Okay, so just let me clarify on that. So if inflation continues to push higher from where it is now, even with sort of the Persian Gulf status quo, you think he can push the consensus to address the supply shock with good old-fashioned rate hikes? It's not going to be ending forward guidance and his famous line about the best way to facilitate inflation expectation stability is to stop talking about it. So even if he like cancels forward guidance and hints at the future of balance sheet downsizing, still they're gonna have to hike rates in at least by the summer.
Yeah, I think the best case for them to keep rates on hold is if he somehow did actually corral the support of the entire committee to actually unwind QT, unwind the Basel III Accords, which, by the way, this is why this has been one of my arguments about why the Trump administration has been so focused on the Fed and taking it over, is that if you look at the way Dodd-Frank was written, they don't actually need to unwind Dodd-Frank legislation to unwind Basel III. They can
Yeah.
do it entirely through the Fed.
Yeah.
Dodd-Frank gives the Fed the authority to change all those ratios itself, and they can set them all to zero. Right? So all they need is the Fed to do this. Now, in the unlikely case he could get the rest of the committee there, then I do think, and this probably is where Danny and I might have a bit more overlap here, is that I think Kevin Warsh, based on his commentary, seems to think a lot more like Danny, that QT is going to have major effects. And that's one of the reasons he's justified the ability to have lower policy rates as a result. And so if he were able to get the committee to go along with that, big bang reform of the Fed, then
Mm.
yeah, maybe you don't get the policy rate hikes. I just think that's going to be really hard to get that done in a short terms, which means they're going to have to go for hiking rates.
Okay, perfect. That summed it up just the way I wanted to hear it. Danny, same to you. How do you view this short-term imperative of getting the Fed back on track versus what might be some long-term positive benefits from the regime change that Warsh is articulating?
Yeah, I think it's going to come down to what he wants to do versus what he can do. And so I think what he can do, I'm exactly with Marvin. What he wants to do, I'm a little different. Where I come out is I've seen him be hawkish under Democrat presidents, and I've seen him be dovish under Republican presidents. And his confirmation hearing last week, they have a whole grid of like 12 inflation metrics that the Fed looks at. And he literally cherry picked the lowest one, like trim
Yeah.
mean perfection that lands at 2.3 as a means of trying to get the committee to justify rate cuts that I think clearly Donald Trump wants. I think that's a mistake, by the way, because I think the populace is screaming and yelling and saying inflation is the number one problem. And I think if Trump were to want to win the midterms, which look a little iffy here, they would need to hike.
More than a little.
That they would need to hike today and get on with it, quickly. On the some of the other things that he wants to reform, I'm very much in favor of getting rid of the dot plot. It's been a disaster. And forward guidance, it's been a disaster. I think the default stance of the Fed should be do nothing. And if the economy is in a solid place, if inflation is contained, if unemployment is reasonable or at a low level, they don't need to be out there giving speeches 8 times a week and telling us what they think. Just leave it alone. Let the economy, the capitalism does the job for you. It takes care of everything. The investments will go where they need to go. Consumption will go where it needs to go. Just back off. And they should be in the shock and awe business. When you have a
Yeah.
COVID shock the economy with a massive jolt, go for it. When you have an inflation shock the economy with some tightening, get rid of it. But in the default, I think they should be just completely on the sidelines and we shouldn't hear from them at all, in my opinion. On the balance sheet, I I am a very big believer that the balance sheet has, in a quasi-permanent way, distorted financial markets. I'm
Mhm.
a very big proponent of financial conditions and how markets transmit into back to the economy. And financial conditions have been easy, despite the fact that we had 550 bips of rate hikes. And the reason for that is in the bond market, there's something we call the term premium. The term premium is like the risk premium that investors should demand to own 10-year bonds. And if you look at the world we're in, we have crazy high deficits as far as the eye can see. We have inflation sticky above target. All of these things should, and growth is well above potential for 5 years running. All of these things should suggest that we should have a much more normal term premium, and it never seems to be able to go up in any meaningful way. The reason is, in my opinion, you can tie it back to when the Fed started buying bonds, and they weren't buying T-bills; they were buying 5-year, 10-year sort of duration, and it has compressed that fair value metric in the bond market. If you were to just use the simplest model for the 10-year, you'd say it should be around nominal GDP. So then it should be 5.5 or 6%, on a running basis. But it has been persistently about 100 bips below this. And the reason I say that is the balance sheet. So by all means, I have said they should be doing asset sales out of the balance sheet, meaning take the bonds that you own, sell them to the street, and if you sell them to the street, that will the market will need to absorb a larger supply of bonds. It'll take a compensation, meaning in higher rates, in order for that supply to be digested. And that will moderate the equity market from any sort of bubble risks. It'll moderate financial conditions, and it will help deal with inflation. So I'm in belief that this is a good, noble objective. It's inconsistent with his objective for lower rates, and it's inconsistent with the president's desire to keep equity markets up at all times. I think most people would agree with that. And so I think it's very unrealistic they do anything of this. I do not believe, and we're getting into nuance here, but like an operation twist where you sell 10 years to buy T-bills has the same impact as actually selling 10 years outright, because I believe that if you want to get a proper reaction out of the bond market, reserves need to go down so that the banks have less organic demand for these bonds, and you get to the proper, market setting the price of the 10-year, which I think is still distorted. The other thing about it, why I think it's an unrealistic policy that they're going to do anything with the balance sheet at all, is they just panicked in the fall and said, the funding markets were a little iffy and reserves as a percentage of GDP are at lower levels. Like they're basically at 2010 levels. And so they're very concerned about the impacts from that in the funding markets and some disorderly movements in markets, to the point where they did 40 billion a month of like mini fake QE, whatever we want to call it, to moderate to increase reserve balances or keep them at a higher level. And so the fact that they just panicked over that doesn't lead me to believe that they can do any meaningful asset sales off the balance sheet. So I think it comes down to what he wants to do, which is cut rates to placate, Trump, and to shrink the balance sheet, maybe as a reason to justify rate cuts, which are otherwise not justifiable. But I do believe he does firmly want the balance sheet shrunk. I just don't think it's realistic now. And so now as he enters the Fed, I think he can't do anything he wants to do. And so I think for him to really be a meaningful Fed chair, he's going to have to move to where the committee is. The committee has moved to neutral, meaning we're on hold for the foreseeable future. They're not hawkish, but he's going to have to move towards them. Waller, who I see as the most perma-dove on the Fed among the intellectuals, if we take out, political appointees or whatever. But if we look at the intellectuals on the Fed, Waller, he came out and said in a speech a week ago, even if inflation went to 2%, I don't support rate cuts anymore because the labor market is stable. I understand the labor supply issue. It's uncomfortable, but I now understand it. And he basically was like, I don't support rate cuts. So if you lost Waller, I don't see any way that Warsh, even though he wants to cut rates, can get the committee there. So his job now is, I need to gain the respect of the committee so that 6 months, a year from now, I can engineer the direction we want to go. And which direction we want to go, this is where I just come back to what Marvin said. I believe economic conditions dictate that they have to hike. And I'm of the view that, they're below neutral by 75 to 100 bips now. If they were smart, they would nudge their way back to neutral, in my estimate of neutral. But if they don't, I think the odds of them having to slam the brakes is significantly higher. So again, I think I come to the same place as Marvin. I just think his desire is for lower rates because that's what Trump clearly wants, and I think that's a mistake. But his
Okay,
desire
well,
is
look,
on.
we're sort of approaching here to the last 5, 10 minutes of the podcast here. So I think, yeah, you've both articulated the dilemma. I think it's still not convincing, the priorities. Is it because, he has cited that he's going to focus on the real economy rather than the models, which means he should come to the same conclusion that you two have both articulated well, that monetary policy is not neutral. So the idea that he can sit below neutral while we're having inflation press higher, not only in the US but globally, is a pretty big call. It's actually saying he's going to come in and be chair and not do anything. So I think he has a lot more pressure on him to act than you guys are articulating. But I also struggle to call whether how he's going to respond to that pressure. But anyway, let's finish up here. 5 minutes, last comments from both of you on how you would like to wrap this up in terms of either the view of a Warsh Fed or how the U.S. economy copes with the current policy settings. Danny, a few minutes from you.
I'm in the we have a very high risk of overheat camp. When the Iran war hit, as I said, I thought it was in the cyclical upside view. The
Hmm.
Iran war was potentially a tightening shock on its own. And if financial conditions, we're starting to price rate hikes as a possibility. We were pricing a little bit higher 10-year yields. Obviously, oil has its own impact. The dollar was a little bit stronger, and equities were a little bit weaker, and about an 8% drawdown.
Hmm.
If that had persisted and continued in a bigger way than that, but if it had continued, I think that we probably would have been able to skate by without them needing to hike rates. Uh,
Okay.
I wouldn't have said rate cuts, but I would have said that we could skate by and probably get by with demand sources of inflation coming down while the
Right.
supply stuff works through the system. The issue, as I see, is one, Trump responded with a bigger defense budget than before, and so
Yeah.
that's more fiscal. And then you have financial conditions have eased in the most rapid way I've seen in a 1 month basis. Maybe Liberation Day after the worst of it. But other than that, you have to go back to 2020, 2021 to see how financial conditions have eased. And this creates demand upside pressure in response to shrinking supply. So I'm in the camp that, we're probably going to overheat because the Fed as an organization is not going to be quick to tighten. You have the Bank of England, you have the ECB. They're understanding the inflation expectations channel a little bit better, and that, this is not the first shock, this is the second shock, and that they may need to tighten, even though their economies are far weaker than the US. They have that bias, even though we'll see how they actually act.
Yeah.
And then you have the Fed who's like, we are well positioned to, you're going to hear this Wednesday. We are well positioned to wait and see how it plays out. You'll hear that 10 times from Powell. And I think that waiting is passive easing, and that passive easing is worsening the problem. And
Okay.
every consumer survey is basically telling you, I'm ready to jump off a bridge unless you deal with inflation. They're like
Okay.
at
All right.
75
All right.
years, so I
Okay.
think overheat is the risk.
Okay. Thanks for that. Marvin, how will you finish up on that?
Well, yeah, I mean, leaving aside the potential for a far worse global economic outcome, which may have some worse effects, I definitely think that they're certainly running the risk of overheat. And I think that, if you recall what I wrote about why Trump would ultimately end up appointing a hawk, even though he was providing or providing a lot of commentary suggesting the opposite, was that he was trying to put pressure on the Fed when he didn't control it to cut rates to affect, given the long and variable lags of monetary policy,
Yeah.
the economy heading into the midterm elections. Now it's too late. You're not going to cutting interest rates now doesn't help. It's too late.
Yeah.
And that's why, look, we saw our first sign of the switch in Trump. He did say, I'm not against cutting or raising interest rates for
Yeah.
inflation. Now, he did say, oh, we have to have lower interest rates than everybody else because we should. But I mean, that's kind of very Trumpian. And so I definitely think they're going, they are all aligned to high, they all have the proper incentives. One, I think, Donald Trump cares far more about being on Mount Rushmore in a century than he does about the stock market today. And
Mhm.
that ain't going to happen if he is known as the hyperinflation president. Um, uh, so I do think that the chances are much higher that they will actually end up raising rates than Danny. I will say something to this point about fiscal policy. It's quite interesting. I think the politics are working against him. He really does have to, win. I mean, have a decisive win in this war and pretty quick. If he's going to
Mhm.
get it done, or it's not going to be in time for the midterms. But if he doesn't have the political capital, he's not going to get this budget through. And if you look at fiscal policy, the interesting thing is, I mean, to their credit, they actually did cut spending in real terms, not nominal terms, in the One Big Beautiful Bill, right?
Yeah.
That was one of three times in the last half century that Congress has done that. So let's give them a little bit of credit there. And if you look at the budget he proposed, yes, he's expanding military spending a lot, but he's also cutting everything else a lot. Now,
Mhm.
the interesting part of that is that these things don't have the same fiscal multipliers. If you look at the work of my dissertation advisor Valerie Ramey at Stanford University, um, she shows that military spending has a big multiplier.
Yeah.
um, Transfer payments have near zero multiplier. So all the stuff they're cutting has near zero multiplier. All the stuff they're adding has positive multiplier. This
Yeah.
is adding to Danny's case of overheat, baby. So
Yeah.
I think an interesting juncture for us to see how things go from here, and it's really interesting to get the difference and similarities in view that we've had here. Before we close out, I think we do have a couple more minutes on this, Mark. I'd actually like to ask you a question, if I may.
Sure. Go
So
for it.
you've gone through this, you've listened to us. What are you thinking on some of these issues? I mean,
Yeah.
you've been one of the best currency managers I've ever come across, and that's 20 years in on the sell side talking to the best currency managers out there. So that's a big
Mm.
statement.
Mm.
And you have also been a global macro manager and done very well with that. So we're facing an unprecedented sort of regime shift on a lot of different fronts here. How do you look at the way Danny and I are looking at this, and do you differ in places, or what are you thinking?
Well, I think you could probably gather from my little quips when you both spoke that I actually think Kevin fully understands that he's coming into a hot seat. I think he's not going to be as careful and timid as maybe Danny was suggesting in any case. I think he understands he's coming in and he is going to be very strong in terms of pushing the restructuring of the Fed and perhaps try to get some announcement effect out of the implications of the downsizing of the balance sheet and the end of the dot plot and the end of forward guidance and a lot of these things, but also fully addressing the inflation issue and say, we might not be able to sit through this at neutral unless, as I mentioned about this sort of new doctrine in addressing pure supply side shocks, there's a fiscal and industrial policy response that's going to be strong enough to let the Fed off the hook. That's the path the Japanese have taken. The G7 collectively have released, the largest amount of, petroleum stock from their reserves they ever have. So there is a big effort to use non-monetary policy tools to address this shock. But the shock needs to be reasonably short-lived. So this is why the cutting of the tail risk 2 weeks ago was, I think, so instrumental in driving equities through the roof. And you say I'm a long-time currency manager. I have changed so much in terms of my global macro approach in the last 10 years, where everything I'm trading these days is relative equity market performance and relative productivity and growth stories, not relative interest rates anymore. And I think the stock markets and the earnings stories are like my clean indicator that I focus on now, that cuts through all the noise, that cuts through the restructuring in the economies with all the structural issues making it so hard to use the leading indicators that we've all been trained to use. And I just think the power of that stock market rally from the moment the ceasefire was announced for US, Japan, North Korea, sorry, South Korea, Taiwan, the countries that managed to break to new highs, they're telling you the story of this cycle, that they're not very interest rate sensitive. You cut away the tail risks, that growth story is gonna power on, and you really don't need that much accommodation here. So I actually think that. I think that Warsh will probably be given the green light to adjust monetary policy a bit tighter in the US, not much, but elsewhere then they have to, because they're not going to have the same sort of industrial policy and fiscal policy responses to help address this cycle. And as you pointed out in the beginning, the US is so better off in terms of its position for this current shock. So yeah, I'm looking for Warsh to make that very quick adjustment to perceptions and sentiment about the Fed. But I don't know. I guess that's maybe that's not market consensus. It's hard for me to tell whether people have that kind of expectations for Warsh. But
Well,
you,
that's definitely useful, and maybe in the comments below you can comment on which of those North Korean stocks you recommend. But
the
Danny,
ones with the most exposure to South Korea.
Danny, for those who don't know where to find you, where's the best place for people to find your work, to follow you, and to find out more information about you?
Sure. I mean, I post snippets of my work on Twitter. You can find me at Danny Dayan 5 on Twitter. I'm very active, posting daily. The link in my bio there will take you to the Macro Musing Substack. That's where I get into the detail, quantitative work, quantamental approach to both the economy and markets. Cover, global macro around the world, cover all asset classes, as well as, trading ideas as well for clients. So follow me there. We have a chat room as well where clients can ask me questions, throughout the day as economic data comes out or headlines come out and whatnot. And we treat it like a trading floor, so it's a little bit unfiltered and fun if you're into that sort of thing.
Fantastic. And for
Fantastic.
those who are looking to follow up on some of Mark's views, you can always find those at the Global Watchtower on Substack. There are two global watchtowers, no, three global watchtowers. I'm sorry. You have the Global Watchtower, the Dollar Watchtower, and the BOJ Watchtower.
Yeah, big week for the BOJ this week.
Yes. So, thank you both, and we look forward to seeing you again in 2 weeks. Bye.
Thanks, Marvin. Thanks, Danny.